policy announcements. I think a lot of emphasis on infrastructure spending, revival of the capex cycle. And I was just reflecting just before the budget. I was on CNBC with pre-budget expectations, and we set out what our expectations were. And it is very rare to see that most of them came true. In taxes, as we like to say, less is more. And therefore, we did not want any surprises by way of wealth tax, inheritance tax. None of them were there. We did not want any increase in taxes. None of them were there. Rather, we had a 4.5% reduction in long-term capital gains tax on unlisted securities. So one of those rare budgets where there is nothing incremental, but we have a slight reduction in the level of taxes, all of which is very, very welcome. The industry had been talking to the government to say that the 15% tax regime, which comes to an end on 31st March 23, if the manufacturing commences before that, should be pushed back. And as FICCI, when we had gone and met up with the finance minister and the revenue secretary, we had suggested a 2-year push forward, and 1 year has already been granted. So if a unit commences before March 24, the 15% tax regime will apply, all of which is very, very good. I think the proposal to introduce a tax settlement scheme within the tax laws is actually quite unique. It has been a demand from the taxpayers over a period of time. People are tired of long drawn litigation, of having to pay penalties and go on litigating. And the proposition now, as my colleague Ajay on the direct tax side will explain as we go along, is that if you file a return and there is a dispute with the tax office within a particular time frame, you can go ahead and file an updated return, pay the tax interest, and pay an incremental 25 or a 50% tax of the tax which is required to be paid, and just settle the matter with no penalties, no litigation, etc. Very, very welcome. I'm sure it will go a long, long way. The introduction of taxes on digital assets is quite interesting. A lot of debate as to whether, in some sense, the government has accepted crypto as being a legitimate asset, etc., etc. And again, I'm sure as we go along, Ajay will present his views. At this stage, all that I can tell you is that we have a separate block for taxing digital assets, like speculation income, like income from horse trading, etc., horse racing, etc. And that is only to be expected. The tax laws do not recognize any difference between legitimate and illegitimate income, and such income will be liable to tax. Very, very interesting. One provision which struck me a bit odd was taking away of the concessional tax regime from overseas dividend. Increasingly, India is globalizing. Indian companies are setting up presence overseas. The IT majors, the TCSs of the world, the Infosys, etc., have companies overseas, branches overseas. But if there were companies and dividend came in, they were liable to tax at 15%. Now they are liable to full tax. I just couldn't understand. There wasn't, of course, a mention in the finance minister's speech, but I couldn't understand the rationale behind it. The one provision which struck me to be a bit odd, and Sanjeev, as FICCI, we need to take that up, is an enabling provision which has been introduced in the GST laws, under which input credit can be restricted as may be prescribed by the government against output credit. The entire thesis of GST is that whatever is the input credit, you can set it off against output tax which is required to be paid. There are no limitations on that. And for the first time, the government has just put in an enabling provision under which they can prescribe how much of input credit can be set off against output. And I'm just worried, just from sheer experience, Sanjeev, that once such a provision is introduced, it then takes a life of its own, and you will go on seeing 90%, 80%, and then again, who knows what states will want to do of their own. As it happens always, quite a few changes on the tax laws. There are many changes which reverse some of the tax judgments which have come. But all in all, very, very positive. All in all, a step very much in the right direction. So what I will do now is to hand over to Sanjeev for his comments on the macro business. How does he view the whole thing as the leader of one of the largest companies in India and as a leader of the Apex Chamber of Commerce? We will then have Ajay talk in depth about the direct tax provisions. My colleague Ritesh will explain the indirect tax provisions, and we'll be happy to take on question answers that any of you may have. So Sanjeev, let me again thank you, welcome you, and hand it over to you for your comments.
Thank you, Dinesh. Thank you for inviting me. And it's an honor to be amongst the foremost tax experts in the country. Yeah, somewhere way back, I had finished my chartered accountancy, so I have a semblance of understanding as far as the taxation goes. But let me just give a perspective more from a business perspective, from a macro perspective, and I leave the taxation to the experts. I would really look at the budget from three angles: is recovery of the economy, relief to the stressed, and the reforms. Yeah. Let me pick up first the recovery of the economy. I think we should be pretty proud that we have recovered the lost ground, which we did in the first year of the pandemic. So the economy had shrunk by 7.3%, and this year we are going to grow by 9.2%. So we are back to a $3 trillion economy. And in fact, a percent point ahead of what we did in 2019-20. So that's a good bit. But I think the challenge before us, as many of you would realize, that often turnaround is easier than sustaining high growth. And all of us crave for the economy to grow at a sustained growth rate of 8-9%, which then in 5 to 10 years' time could put us in moving toward the middle income country. That's what we all crave for. Now, one of the things which is remarkable in this budget, before that I'll come to is what are the stress points in the economy today? The two biggest stress points in the economy today is, one is private consumption, which when you look at it from a demand side is the largest component of our GDP, and that is still below the 2019-20 levels. So that's a big issue. The second link to private consumption is the fact that the private capex is not moving, which is intertwined and understandable when there is less consumption or low demand, and the capacity utilization is in 60-70% range, then new capex doesn't happen. Now, if we have to propel the economy, then the government spending has to be center stage. So Madam Finance Minister has been bold, and she has not fallen prey to neoclassical economic theory that you need to rein in the fiscal deficit. The fiscal deficit is still projected at 6.4% in the new year, and against 6.9% this year. And from a long-term perspective, the guidance is to bring it down to 4.5%. So there is a glide path and not an abrupt reduction in the fiscal deficit, which is absolutely the right thing to be done. And the biggest component which pleases us is the 35% increase in the government capex. And most of that is going in for infrastructure development. Now, 35% moving from 5.5 lakh crore to 7.5 lakh crore is substantive. And what I believe this kind of money could lead to is spurring the demand in several related sectors linked to infrastructure development, which in turn will lead to capacity increase or utilized capacity increase, which will lead to private capital investment, which in turn will lead to more jobs being created, more demand, spur in consumption, and the virtuous spiral will kickstart. That's what we need. And if you can get 8% growth, which the economic survey talked about last year, we would be on a great path to sustaining high rate of growth. So that is something which pleases me immensely, the boldness of the budget. The second would be is stress to the poor, or the stress which has been there to the poor or the impacted sectors. Let me first talk about MSMEs. MSMEs, by the very nature, are fragile, and the pandemic has severely impacted them from a cash flow perspective, from a business perspective. And when you look at it from a lens of touch sectors, which is hospitality, restaurants, tourism, then we are still talking about they have not yet reached anywhere close to the 2019-20 level. So what the government has done is the credit lifeline that they had given is the guarantee scheme that they have extended by another year and earmarked 50,000 crores for hospitality sector, which is absolutely fabulous. The other thing which they have done is normally this credit guarantee scheme is for existing borrowers. For new borrowers, they have a scheme whereby they are increasing the outlay, they are revamping it and adding another 2 lakh crores. This would add a significant lifeline to millions of MSMEs. And India is a country of MSMEs. Yeah, we are talking about 70 million MSMEs in the country. And this CGLS scheme had only impacted about 13 million MSMEs. So we are talking about a large number of MSMEs which had not been able to get. The other thing which I would pick up more from a reform perspective, but because it relates to MSMEs, MSEs today there is no system of rating MSMEs. And because there is no system of rating MSMEs, they are not able to access credit from the formal banking system. So there is a provision where they're saying they'll spend about 6,000 crores to put into motion rating scheme for MSMEs, which will be another significant step. Yeah, and very clearly they're holding on to the budget of Manrega. They're holding on to the budget of healthcare. They are increasing the budget on education. These are again auguring pretty well. Then when we look at it from a reform perspective, what we as a business crave for is the consistency of policy and certainty of tax rates. That's what we crave for, right? And there was a fear that things like wealth tax, etc., will be introduced. Thankfully, the finance minister has not fallen prey to either raising taxes or introducing taxes which we know by history are not effective. So that's wonderful bit. Yeah. The other is, if you look at across sectors, the steps that are being taken for digitizing the economy, there are several. Yeah. And that again augurs well, because that is going to lay the foundation of the new India, which is absolutely brilliant. And then, you know, for instance, when you look at the net zero and climate, government is now started to take some very positive steps. Besides the PLI and additional outlay for solar, government is also talking about green bond, because that is so important to provide finance at concessional rates for people who embark on decarbonization of the economy. So that's again a step in the reforming the economy and making India future fit, if I may tell so. Last but not the least, we have always felt there is a trust deficit when it comes to between the government and the bureaucrats and the business or the taxpayers. The very fact that you don't raise the tax. So instead of looking at bringing in more tax, you're looking at widening the tax base is a good sign that the government trusts. The second important bit, like Dineshji, you were rightly saying, is bringing in your ability to revise your return within a period of 2 years is again telling a taxpayer, guys, we have started trusting you. And if you have made a mistake, revise it within this 2 years if you feel, and pay your money and reduce. The other is on litigation. Many of the issues which are substantive in law are pending in high courts and different courts of the country. And the government has said during the pendency of these cases, yeah, you're not going to file more cases against the SSC, which is again absolutely the right thing. We have so many pending cases. And if there is a question in law, if it is waiting adjudication, why do you need to go and file more cases? Yeah. So this, I would believe, is sending a very clear message to the taxpayer, to the business community, that we have started trusting you. And this will go a long way, because the government and the business have to work in tandem, have to work in partnership for the growth of the country. So if I have to just summarize, I would say that it is a consistent budget. It is a bold and a courageous budget. And very importantly, it is a growth-oriented budget. Thank you, Dineshji.
Thank you so much, Sanjeev. And just a couple of very quick follow-on to the points which you mentioned. I think one of the other things which I did see, Sanjeev, which was very, very welcome, is that many of the proposals which we put through as FICCI have actually found favor.
Which is again a good sign that the government listens to us.
Absolutely.
Yeah,
No,
many
no
of the
question.
things that I spoke about were very much part of the FICCI proposal, and you have been an integral part in drafting those proposals.
So it's quite interesting to see how the government is listening, wants to make things ahead. And there was really there were no, for the first time the finance minister was talking to say thank you taxpayers, we are grateful to you, acknowledging their contribution, which
Absolutely.
is a big thing to happen. So
Absolutely.
I think all very, very positive. I think you mentioned about PLI scheme, and again a new PLI scheme for manufacture in green energy. Again, a very, very welcome announcement, and a substantial almost 18,000 crores being set aside for it. So all, I think you use a word, Sanjay, which I must totally agree with, which is bold. She could have made incremental changes. Instead of making incremental changes, she has just come back to say, the collections are robust, I can afford to take a risk, and I am willing to take a risk because I know that if the economy grows, we will be able to collect more taxes and take on from that. So thank you, Sanjeev, so much. I know your time is very, very valuable. Thank you for joining us. We will let you go. Yeah, of course, welcome to hear taxes, which I don't think is top on your priority. But thank you so much again for being with us, Sanjeev. And Ajay, if I can hand over to you to talk to us in depth about the direct tax provisions. And then I will invite Ritesh to join in for indirect tax provisions. And as I mentioned earlier, please feel free to send your queries and we'll be happy to respond. Ajay, over to you.
Thanks, Dinesh. Thanks, Sanjeev. Good evening, everybody. So, we'll spend the next half an hour or so going through the changes on the direct tax front, and then I'll hand it over to my friend Ritesh for indirect taxes. I think the key, if I have to put a central theme for the budget, we keep hearing about tax stability in the tax framework, etc. I think, this budget sort of follows that to the T. There is no unwanted tinkering of rates, no changes in procedural things, no new forms, nothing of those sorts. Whatever changes are there have a very strong reason behind it. It could be some of it, what the taxpayers wanted, which benefits the taxpayers. Some of it gives clarity to the taxpayers, even though, it does increase the tax cost. But in that sense, all the changes which are proposed are things which have a very strong reasoning behind them. Firstly, the tax rates remain absolutely unchanged for both corporates and individuals. There's no change in any slabs. There's no change in surcharges. There's only one change that's been done in the tax rates, which is more for cooperative societies and cooperative societies which are between certain amounts of income. This is more to align the tax rates and align it with companies and not for any other thing. One of the key changes that's been brought about is the change in surcharge on transfer of capital asset, which is long-term capital gains from transfer of any capital asset. Hitherto, any capital gains, whether short-term or long-term on listed shares, the surcharge was always capped at 15%, so you were not going to the 37% surcharge, even if the incomes were beyond those thresholds. That was not there for unlisted shares. This is something that there was an ask more so for people who are today exiting, startups who are diluting, companies which are doing transactions. There are mergers, acquisitions, which are happening in the unlisted space. I think this is a very welcome proposal, where the proposal is to reduce or cap the surcharge on long-term capital gains on transfer of any asset at 15%. Therefore, for individuals who are at the highest slab rate, where a 37% surcharge was otherwise applicable, there'll be a saving of about 4.6% in the effective tax rate on long-term capital gains. There are a set of amendments relating to amounts received on account of medical treatment, compensation, etc., because of death and treatment relating to COVID-19. This is something that, again, was asked for a while. There were companies which had taken these positions based on certain old circulars which were there, which basically said if there is any person who dies during the course of employment and any compensation is paid to the legal heirs, those would be exempt. And now they've brought it in, clarified it, and therefore two things. One, any amount received by individual for medical expenses, which is actually incurred by him or her on account of illness relating to COVID-19, will not be considered as income of such person. Therefore, that becomes exempt. And the amounts received by family members of deceased person, again, if received from the employer, there are no monetary limits. If it's received from other people, there's a 10 lakh rupees limit. If it is received within 12 months from the date of death, both these will not be taxable in the hands of the recipient. They again welcome proposal during these tough times. There were two provisions which were having, so to say, a sunset or last date, which was very close to current period. One was the concessional tax regime. There was a 15% concessional tax regime announced for new manufacturing companies which set up manufacturing unit and commenced production before 31st March 2023. A lot of the industries who started setting up plants which have 18 to 24 months or thereabouts time for production to commence, actually their projects got delayed because of lockdown, because of COVID, etc. Therefore, the 23 date, there was a request for that to be extended, and the FM has considered that. And the last date now has been moved from 31st March 2023 to 31st March 2024. Therefore, those companies which commence manufacturing or production before 31st March 2024 will be eligible for those 15% rate. But all the other conditions relating to it should not be formed by reconstruction, splitting up, which should be a new facility that's set up. All those continue, just the date has been moved. Similarly, the date for the last date for incorporating a startup and being eligible for a tax holiday has been extended to 31st March 23. So in both these cases, a 1 year extension has been provided. What, in my view, can be termed as one of the most significant proposals in this budget is this whole provision relating to an updated return. So until now, you could file your return, which was called the original return, and you could revise it if there were any errors, omission that you realized. And there was a time limit for revising the return, or you could file a belated return. If you didn't file the return during the timeline that is provided, you could file a belated return. There was no provision for you to update your return or change your return if there was no error. So, now they have brought in a provision which says that you can update your return within 2 years from the end of the relevant assessment year, which makes it 3 years from the end of the financial year in which that income is there. And you can update the return. And if you need to offer additional tax, of course, you can't reduce your tax liability in the updated return. When you increase your tax liability, whatever is the additional tax has to be paid. And if you're updating the return within 1 year from the end of that relevant assessment year, then you pay the tax on such additional income plus a 25% additional tax. And if you're doing it between the first and before the end of the second year, you pay a 50% tax. Now, this is a significant change, because if you're permitting taxpayers to update the return, which means you're permitting them to offer some income additional, which they had not done in the original return, is a big thing. This is more a soft, settlement scheme like the VSV scheme, which was there. The soft word I'm using because there's a limited window, number one. And number two, you can't do it after your assessment has commenced and it is pending, or assessments are completed. If there is a search, seizure, etc., you will not be able to do that. But if no assessment is pending, your assessments are not completed for that year, you can file an updated return. And interestingly, you can file an updated return even if you have not filed your original return or the belated return. So you will be able to file this. Where does this become relevant? This is extremely important for avoiding repetitive appeals. Let's assume in year one, a company or a person took a particular position on certain transactions which are recurring, which are there in most years, or a particular contract which has income over a period of 4 or 5 years. And you took a position and you continued that in the subsequent year, and your first year's assessment got concluded and the income tax department took a contrary view. Until now, if the department took a contrary view and you wanted to appeal and you appealed, or even if you accepted, all the subsequent years also had to get assessed and you had to go through litigation. Now, after the first year is complete, in case you believe that that's a position that you would want to accept, you would not want to litigate, at least for the balance year where you've taken a similar position, assessments are not commenced, have not got concluded, you have an option today to update your return, pay that additional tax, and sort of get a certainty and not get into litigation. Of course, that updated return can be assessed or will be assessed, and there's a 9-month period for assessment of that updated return. But at least the issue on which you wanted a settlement can definitely be achieved through this process. The other significant proposal that is there in the budget, which I think over the next 2 or 3 days will be the most discussed, most talked about provision, would be the virtual digital asset. While a lot of these changes are being referred to as a cryptocurrency, crypto assets, Bitcoin, etc., but it's actually much wider, because what the finance minister has proposed is really a separate taxing scheme for a separate class of asset called the virtual digital asset. So you had capital assets. There was a definition for capital assets, which included everything. And then those capital assets, when you transferred, you had capital gains, which was taxable under a particular section. Now they've brought in a definition of an asset class called virtual digital asset. And there's a separate charging section, which brings to tax income that you earn from transfer of these virtual digital assets. And that income is taxable at 30%. There's no distinction of long-term, short-term, like in normal capital asset. And it's all taxable at 30%. Now, this virtual digital asset includes NFTs. They have defined that includes any asset which is created virtually, which has a store of value and all of those. It's a very inclusive definition. And also there's a clause which permits the government to notify certain digital assets which would fall in this definition, which I think is again a very important thing, because this is such an evolving subject. There are new assets which are coming into being every few days, few months. Therefore, the government need not keep amending these law. They just notify an asset and it gets included in this definition and gets into this taxability. Now, what does this mean? A 30% tax, which no distinction between long-term and short-term capital assets. Now, of course, this is slightly higher, or rather 50% higher than long-term capital gains on all other classes of assets. So if there was an investable pool and you invested in shares, land, securities, whatever else, including debt, securities, etc., long-term would be 20%. Here, even if it is long-term, though there is no distinction, it will be a 30% tax. However, the rate of tax on short-term and other income is lower than the highest slab that somebody would be at 43%, etc. But if somebody crosses that 5 crore, the surcharge on this 30% will still be 37%, but this is a completely different regime, all of which gets taxed at 30. Now, there are two other very important aspects here. One is you don't get deduction or allowance for anything other than just the cost of acquisition of that VDA, the virtual digital asset. And second, and this is important to note, is that the loss arising on such transfer cannot be set off against other income, and nor can you set off other losses against gains that you will have from these income. So therefore, it is sort of a different income category. Like Dinesh mentioned a while back, like speculative income, etc., gets taxed separately. You wouldn't get the benefit of set off of these losses against other income. There is also a TDS at 1% on payment made towards purchase of virtual digital asset. There's of course also, if it is done in kind or it's a barter, also the TDS applies, in which case if the cash component is not sufficient for TDS, you need to pay that money, but the TDS brings the whole transaction into the chain. Therefore, it's not that the virtual digital assets were not taxable as we speak today. If there are trades happening, the department would of course argue that these are capital assets. As the law stands today, those gains are taxable. But come 1st April 23, there's a separate regime for this. The other debate that's already started is the fact that you brought in a tax on it, and the tax law recognizes a virtual digital asset. Does that make cryptocurrencies, bitcoins, etc., legitimate? I think it's an age-old thing that gains from illegal transactions and legality of transactions have no bearing on taxation. Those are two different things. There's also this whole famous position on just because you go and pay a property tax, does that give you a title to the property? Of course not. Those are two different legislations. Therefore, the tax legislations run by themselves, and we'll have to wait and see what will happen on virtual assets. Otherwise, what will RBI do, permit it, not? That's something that we'll have to do, but at least there's a taxation regime that's been put into place. Of course, the finance minister also announced that the government themselves wants to do a digital currency. This could possibly be a taxation regime that's been put in place for that as well. There are certain other small amendments relating to deductibility of expenditure against business income. The first one is, of course, all of us knew that any payment for offense or what is prohibited by law was never deductible. The penalties were never deductible. They have now clarified it to say even if it's under a foreign law, you will not be able to get a deduction. And they've also brought in a clause to say that if there is a payment made for compounding of an offense, whether under Indian law or under foreign law, that's also not deductible. There were certain taxpayers who'd taken this position, and there were case laws, courts which had upheld such positions to treat the health and education cess as a deductible expense. Of course, tax is not deductible, and the view was that health and education cess is not tax, and therefore it's a deductible expense. Now, they have brought in a clarificatory amendment, and it is retrospective from 1st April 2005 to say that a health and education cess is included in definition of tax and therefore not deductible, will not be available as a deduction. You'll have to go back and see what you've done in the last few returns which are not yet assessed. The immediate last return can be revised, what can be done, because there will be interest implications on this, because this is a retrospective amendment. Of course, there are cases which say that on a retrospective amendment, both interest and penalty should not be applicable. Those will be available to us. But this is something that we'll have to just bear in mind. One of those few retrospective amendments which are there, the other one is on goodwill, which I'll just come to in a while. One other amendment, Dinesh spoke about this to say that the rationale behind reducing the rate or doing away the concessional rate of 15% that was available for dividends received from foreign companies. So Indian companies receiving dividends from any foreign subsidiary or company where there was a minimum 26% holding was taxable at 15%. And that's now been removed going forward from 1st April 2022. Whatever dividends Indian companies receive from foreign subsidiaries will get taxed at normal rate, like domestic company dividends. Of course, the memorandum does mention that this amendment is being carried out to align both the rates and not have differential treatment for foreign subsidiaries and Indian subsidiaries. And of course, you'll have to remember that there is Section 80M, which gives you a deduction for dividends which are declared if there is a dividend income. That will continue to be available. That is available for foreign subsidiary dividends even today. Therefore, the impact will not be too much. There will at least not be a cascading effect. But at this point, the concessional rate of 15% that was available will not be available from 1st April 2022 onwards. This is again another change to just overrule a Supreme Court decision which had basically held that assessment proceeding concluded and order passed in the name of a predecessor entity. When a merger has happened or any reorganization has happened, the entity which no longer is in existence and ceases to exist, if an assessment was passed on such an entity, those assessments were held to be bad in law, and because you can't pass assessment orders and assess an entity which does not exist, they are now amended to say that tax proceedings which are made on a predecessor entity during the pendency of a business reorganization will be deemed to have been made on the successor entity. The pendency is really the period between the date of filing of an application before NCLT and the date of receipt of the NCLT order. Those will continue to be made, or if they are made on the predecessor entity, they'll be deemed to have been made on the successor entity. So that's one of the changes. The other is, in case where a business reorganization was effective from an earlier date, if there are mergers which came into effect from earlier dates, then they have introduced enabling provisions to facilitate the successor entity to file modified return. And there were always these issues that you couldn't revise the return because the date for revision had expired, and there are certain courts which had held that you will not be able to revise the returns. This is, of course, depending on how you look at it, beneficial to the SEC that you can revise returns if you do it within 6 months from the date of the NCLT order. So one good thing, they have not put a date again here. They've linked it to the NCLT order. Therefore, you get a 6-month period after you receive the NCLT order to revise your returns. There are certain amendments to curb anti-avoidance, bonus stripping. Very simply put, bonus and dividend stripping provisions will apply to mutual fund units, REITs and InvITs and AIF units as well. Some amendments relating to cash credits and unexplained, undisclosed income. On cash credits, loans and borrowings, the onus has now been cast on the SSC to explain the nature and source of the person from whom it is received. except if that creditor or lender is a regulated entity, and then you don't need to because they anyway are regulated entities. The other one is if there is any loss or unabsorbed depreciation that's there, that's not permissible to be set off against undisclosed income. Changes made relating to the reopening. I think last year there were some significant changes around reopening that were made. The time limit for reopening was reduced. The scope for which on receipt of income information the reopening could be reopening could be opened was actually curtailed, to say that if it is only a C&AG audit objection that was there or exchange of information under treaty, they have now brought in any audit objection, not just C&AG audit objection. And also reopening for period up to 10 years has been allowed, where the income escaping is in form of entry in the books of accounts or relating to a transaction or event where there is an expenditure. So this is one other change on reopening. The controversy relating to those reassessment notices which were issued under the old regime. This is the overlapping period between 148 and 148 capital A because of the 3 months extension, where there were a lot of writs and those were allowed in favor of the taxpayer. That controversy would continue, or rather that situation would continue, because there are no provisions which have been introduced to give legitimacy to those reassessment notice which was stuck down. This is another beneficial provision for taxpayers, especially in those cases where there are tax cross-up and that has been done on just being a little conservative to not litigate, and therefore if the refunds have to be claimed or if there are cases where contracts have cancelled, etc. Currently, you could file appeal before a CIT appeals under 248 for getting the amount back, and there was no way you could approach the assessing officer. Earlier, there were circulars which provided for a way in which you could file a refund applications, but those were not there, and therefore you had to go to the CIT appeals. They have now changed that to say that you file an application for refund before the AO, and then if the AO has to pass the order within 6 months, and then you can prefer an appeal before the CIT appeals. There are quite a few changes relating to the faceless assessment. Very simply put, a lot of the things which there were issues which were impacting both the department and the taxpayer, teething issues that were there in faceless assessments, etc. Those have been amended. Basically, they have now put a provision which says that if an assessment which was considered invalid or non-est for not following certain procedures there, that has been deleted, and this has been done retrospectively from 2021 because that's when this started. This is more of a procedural thing. Litigation management for appeals filed by revenue on similar issues. There was always this provision in law under section 115 capital A, which provided the SSC to stop repetitive appeals. If in the SSC's own case, there was a question of law pending before a high court, you could file an application and stop the department from making similar assessment order in subsequent year, provided you agreed that whatever is the finding in the first year would be applied for all other years. And then they would not pass the assessment until that question of law was decided. Now, a similar thing, very simply put, a similar thing has been extended to the income tax department, which really means if there is an identical issue that's pending before Supreme Court or High Court, which of course means it's a question of law, then the senior revenue officials may decide not to file an appeal or not to on such issue for other cases. Therefore, you reduce the litigation provided the SSC agrees that whatever is the finding in that lead case will be applied on other cases. Some small amendments relating to 14A and 43B, again, arising out of decisions which have come recently. 14A, basically those cases which said that if you don't have exempt income in a particular year, then 14A wouldn't apply. They have now brought in a proviso. This is prospective to say that expenditure which is incurred in relation to exempt income will be disallowed even in the absence of exempt income in the year during which that disallowance is sought to be made. Similarly, 43B, there were cases which said that if there is interest payable on loans from banks and financial institutions which you didn't actually pay, but those got converted and deferred to a future date, that conversion was deemed payment. Now they've said that that shall not be deemed to have been actually paid. Therefore, if there is an interest which has got converted into loans, that will not be treated as payment and will get disallowed in the year in which such conversion happens, because you've actually not made the payment. Timelines for notification of faceless assessment scheme has been pushed by 2 years. I think again welcome, because both the department and the taxpayers are getting used to this, and then pushing it to 24 will be good. Scope of revisions by principal CIT has been revised. There were again case laws which said that whether the principal CIT has powers to revise an order passed by the transfer officer or not, and to cancel and direct a fresh assessment. There, it's now been specifically provided that the principal CIT under 263 will have powers to revise transfer pricing orders passed by the TPOs. The CIT appeals have been granted power to levy penalty. There are certain provisions, small ones relating to TDS and TCS, where if there is a non-filer, then the higher TDS rate for who not filed will be there, and that time limit which has lapsed for 2 years, provisions relating to that. There's an exclusion provided for immovable property, payment of rent to individuals and HUF. There's also a provision relating to TDS on virtual digital asset which has been introduced, which is at 1%, which I just touched upon earlier. There are stringent punishments for failure to deposit those TDS and TCS, which is there. Some amendments relating to IFSC, and if I have to sort of sum it up, the key thing here is there are 2 new instruments of offshore derivative instrument and OTC derivatives which are there, and income arising on account of that has been brought in for exemptions. Income arising to a non-resident from portfolio management of securities and financial projects managed by the IFSC manager who's based there will not result in income arising or accruing to them or deemed to accrue or arise to them in India. This is to the fund if the manager is there. Then there is an exemption from angel tax, which was there only for Cat 1 and Cat 2 AF. That's been extended to people even under the IFSC, not just outside. Royalty income, which was there for aircrafts, has been extended to ships. Charitable trust, certain changes, more administrative to align the past changes which are there. 2 very important changes. One is exit tax provisions have been brought in. So there will be exit tax in case of non-fulfillment of conditions that will be there. And there's also penalties which have been brought in. And there's also provisions relating to 1023C and Section 11, which were both running sort of parallel, have been aligned. These are sort of the changes on direct taxes. There are already a lot of questions which have come in. What I will do is I'll request my friend Ritesh to just take us through the indirect tax changes, and then we'll probably come back and I'll let Arun moderate the question and answer session.
Hi, thank you, Ajay.
Ritesh, do you want me to share the slides and you'll prompt me to change, or do you want to just
Yeah, Ajay, because the control is with you. Yeah, thanks. So, every year we think that insofar as budget is concerned, GST is not a relevant factor because GST Council has now taken sort of charge of all the GST related amendments. However, every year we see some critical amendments which has some very important impact. And this year also we see a number of such amendments more focused on credit eligibility, more focused on tax evasion, etc. Yeah, Ajay, and then next slide. So the first amendment relates to input tax credit. As you would all recollect that in the last year's budget, there was a proposed amendment to the GST law, which spoke about eligibility to take ITC only to the extent the details were furnished by the supplier and communicated in the manner prescribed. Now, the amendment, while it was there in the last year's budget, saw the light of the day only with effect from 1st January 2022. And we thought that, these are the substantive provisions which enables the government to recover the tax if supplier has not filed the returns. However, what we have seen in this year's budget is another very draconian amendment under Section 16, which has said that the input tax rate available shall be restricted to the extent specified under Section 38. Now, 38 is the communication which was supposed to be sent to the recipient when a supplier files the return. So we've all heard about Annexure 2B, which speaks about the input tax credit relating to the returns filed by the supplier. But what this Annexure 2B does is, it's an auto-populate statement, as you must all be aware of. But what it does is, it does not only specify the details of the supplies of the supplier, but also restricts the credit in a lot of circumstances where the supplier has defaulted. And the way if you I'll go through those particular clauses, but the largest question is, what is the ability of the recipient to ever know on which of the occasions has the supplier defaulted and when is he not supposed to take credit? Because in many of these instances, a recipient would never come to know whether any of such situation has arisen. So let us just go to the first clause, which says details of inward supplies in respect of which credit or input tax may be available to the recipient. This is fine, whatever supplier files in his GSTR1, I will see it in my annexure 2B and I will be eligible to take credit for that. It then also speaks about details of supply in respect of which credit cannot be availed by the recipient. And this is dependent upon the compliance by the supplier. So what it says is supplies by the supplier within such period of taking registration as may be prescribed. The first clause seems to be related to a situation where there is a new taxpayer, he has taken registration, and the government can specify a particular time period before which the recipient would not be eligible to take credit. This is what it appears to be as of now, but that is how sort of the clause reads as, and maybe this is to prevent the issue of fake invoices, new registered fly-by-night operators who take registration who sort of vanishes. The second says who has defaulted in payment of tax for a prescribed period. How would the recipient know that a supplier has defaulted in the payment of tax? And it is not clear as to how annexure 2B will calculate my credit. What would be the credit which would be showcased? So is it that if the supplier has defaulted, none of his invoices would appear in my annexure 2B? Is there some proportionate mechanism basis which the invoices would appear? If he has made part payment, he's made full. Nothing is clear in terms of how this has to be addressed. The third speaks about GST1 liability exceeds the amount of tax paid by me in GSTR 3B. Now, we have recently seen an amendment which says that if my GSTR1 liability exceeds GSTR 3B, that needs to be treated as self-assessment tax. Now, and what it says is it needs to exceed by a prescribed limit. So this effectively means that the supplier has reported his invoices in the GSTR1 returns, but with respect to, let's say, some of the invoices, he might have not paid the tax in GSTR 3B. Now, let's say there are 5 recipients of the supplier. There are 5 invoices in the GSTR1. I am the recipient. The 4 invoices pertain to some other recipient. Now, if the supplier has not paid tax with respect to 2 invoices in GSTR 3B, and let's say the tax paid is 80%, then will my credit be also restricted to 80%? How would I come to know that my invoice is the one which has not been communicated, reported in 3B, or is it somebody else's invoice, or is it going to be proportionate? The next clause is saying that supplier who during such period as may be prescribed has availed excess credit. Now, again, a very, very draconian clause, because what it says is that if the supplier has availed excess credit, then the credit would not be available to the recipient. Now, here there is a rider to say that during such period as may be prescribed. Now, what it appears, and we'll have to clearly see the rules around it, what it appears is that this relates to probably fake invoicing, where, let's say the department has issued a notice to a supplier to say that, you are taking credit on the basis of fake invoice, and maybe they issue some kind of a communication because of which even the subsequent recipient would not take credit. We must appreciate that this provision would actually have a dominoes effect, because the supplier has taken a wrong credit, has availed excess credit. All the recipients would now not be entitled to take credit. The another provision is where such credit would be restricted is who has defaulted in discharging tax liability in accordance with the provisions of section 49(12). Dinesh mentioned about this particular provision which provides for a maximum output liability which can be paid through credit. So if I have 100% credit available, there are the government can prescribe mechanism by which I may not be able to utilize such credit, and in such situation my credit of the recipient, if the supplier has not complied with this provision, the recipient's credit could be restricted. Again, what is the basis of a recipient coming to know about it in terms of whether the supplier has complied with this provision or not? The mechanism is not clear. And the last is, of course, a residual clause which says such other class of suppliers as may be prescribed. Yeah, Ajay, next slide. This is a beneficial provision. So we all know that there are time limits under the GST law with respect to taking GST credit, with respect to issuing credit GST credit note, so where you can take a GST adjustment, and with respect to amendment of return. And there are several other return filing provision where the time limit is September of the next financial year. This has been amended to 30th November of the following financial year. So there is an extension. Practically, what this would mean is that either you do this in the month of October, the due date for the month of October, which is by the 20th, or the October returns get delayed up to 30th November. The next, amendment is with respect to, output supply returns and its communication to the recipient is subject to such conditions and restrictions. So what was happening was that, when there are provisions, in fact, there were press note releases, not provisions, which stipulated that if a supplier has not filed the returns for the previous month, then he will not be able to file subsequent returns. So there was an argument being taken to say that the provisions provide that the supplier shall file the return. So you cannot restrict the right of filing the returns by the supplier. Now the provisions have sort of been amended to take care of this anomaly to say that the filing of returns and the communication to the recipient shall be subject to such conditions and restrictions. We all are aware of the provisions relating to matching of credit, section 42-43, which was a huge point of dispute to say that these provisions were never notified, and still, there were liability demands being raised with respect to matching of credit between the supplier and the recipient. These provisions were never notified, as you all must be aware of. And now, while this were there in the Finance Act, never notified, all the references to the provisions have now been omitted from the law. I already have mentioned about provision under the law, which speaks about, that you may be disallowed filing of your GST or 1 returns if you have not filed the return for the previous period. Now, this was mostly by way of press notes, etc. The substantive provision have now been introduced. There is already a provision for GSTR 3B. The law also now provides that if for a particular month you have not filed outward supply return GSTR 1, you will also not be able to file GSTR 3B for that particular month. Ajay, next slide. Section 41 again is a substantive provision which has been introduced to provide for levy of interest in situations where credit has been taken on a self-assessment basis by the recipient and the tax has not been paid by the supplier. Now, this is a very interesting provision because section 16 already provides for a condition to say that if tax has not been paid by the supplier. Now, the largest dispute with respect to section 16 was what is the timeline where I have to assess as to when would the tax be paid by the supplier. So is it that he has to pay the tax in the same month? Can he pay it after 6 months? Can he pay after 1 year? So there is no timeline which has been prescribed. Now, having said that, there is no timeline which has been prescribed. The other issue is now this section 41 provides for now levy of interest in such situations where he has not paid the tax, and I need to reverse the tax. But when do I need to reverse the tax is not clear. The other interesting issue is that what the provision says is that if he has not paid the tax, I have to reverse. But section 50, which is the provision for relating to charge of interest, has also been amended to say that when the input tax credit has been wrongly availed and utilized. So if you read section 41 along with section 50, even if you have taken credit of the tax which is not paid by the supplier, no interest can be levied till it is utilized. The another issue is, where are the so today, how would I come to know that the supplier has not paid the tax? There is no enabling mechanism by which I would ever come to know that the supplier has paid or not paid. So the machinery provision is another issue whereby somebody could go and challenge to say that where a machinery provision fails, there is no question of levy of interest. We've already discussed about 4912. Dinesh also mentioned this, which sort of introduces limits to the extent for which input tax credit can be utilized for payment of output tax. We have already seen the implication of this provision where notifications were issued where 1% was supposed to be paid in cash and 99% can only be paid by credit, where the income tax liability of a company is less than 1 lakh rupees. In the last GST Council meeting, there was a discussion around transfer of credit, which is lying in the electronic cash ledger. Now, the provisions have now been introduced to say that when it is within GSTN, the credit can be transferred between IGST, CGST, and SGST. But when it is distinct person, that is GSTN in 2 different states, the credit can be transferred only between IGST and CGST. Now, a very simple way around of this provision is that you first transfer the credit within GSTN from SGST to CGST, and then you transfer interest rate from CGST to IGST. They could have actually very well allowed such transfer of credit even with the interest rate, because it is ultimately your cash balance which is lying in your cash ledger. The only rider to this provision is that the credit cannot be transferred if there is an unpaid tax liability. Now, what do you mean by unpaid tax liability is again not defined, whether if a show cause notice is pending or is an order issued, etc., which has not been finalized. So there is no clarity on that front. Ajay, next slide. So there was a confusion with respect to the time limit for filing of refund claims for suppliers who are supplying input services to SEZ developer unit. This has now been clarified to say that the relevant date would be the due date of filing GSTR 3B in which such supplies are reported. So this is sort of more of a clarificatory amendment. There was a dispute regarding the applicable rate of interest. So earlier the law provided for a 24% rate of interest only in the case of a credit mismatch. So if the supplier has not filed the returns and the recipient has taken the credit, there were substantive challenges to the provision per se. However, there was another issue of a levy of interest. But what the department started doing was it started levying 24 interest in various other scenarios. So there is a retrospective amendment which has been made to say that the interest applicable would now be only at 18%. A clarificatory amendment has been made with respect to supplier service by way of grant of alcoholic liquor license. So there was a dispute with respect to levy of GST on this. And what the government has now done is exempted this for the period between July 2017 to 30th September 2019, which effectively means that going forward, this tax needs to be paid. This would be a service and the GST would be applicable on this transaction. Yeah, Ajay, next slide. So we now move to certain custom legislative changes. So the first one is, the issue with respect to the powers of DRI to issue a show cause notice. And recently the Supreme Court in Canon India Private Limited has held that the DRI is not the proper officer for issuance of show cause notice. And a lot of these were sort of set aside. Provisions have now been amended to provide those powers to the officers of DRI audit and preventive formation. And also powers of assignment have been given to the board commissioner, principal commissioner. The question is whether it is retrospective. So there is a validation provision, validation to take any action or functions performed before the date of commencement. Now we'll have to see whether such kind of a validation provision will stand the test of law. What has happened is practically a lot of such show cause notices are on hold, and now those notices would get issued either by the DRI or with respect to the jurisdiction officer. Section 14 is proposed to be amended to provide rulemaking powers to the board to address issues of undervaluation in imports. So there were certain imports which were perennially undervalued, and what there was, it was a practical aspect where circulars etc. were issued prescribing a particular value for such imports. Now there has been an amendment in the law to specifically provide powers to specify rules which can provide additional obligation of the importer in respect of imported goods where value has not been declared correctly. So where there is a doubt with respect to such value, the criteria for selection of goods and checks in respect of such goods. Ajay, next slide. Certain changes with respect to the advance ruling provision. So earlier an advance ruling application could have been withdrawn within 30 days of its filing. Now it can be withdrawn any time before pronouncement of the ruling. The more important amendment is now that the ruling is only valid for 3 years, or if there is a change in law or facts on the basis of which the advance ruling is pronounced. Now this is somewhere going back on the entire amendment which was done with respect to SVB. So in case of SPV, the SVB order would have to be obtained every 3 years, and the law sort of got amended to say that now there is no need unless there is a change in law and facts. Now, with respect to advance ruling, you take an advance ruling. There is no change in facts and law, but the advance ruling is applicable only for 3 years. So after 3 years, you have to go back and take another advance ruling with the customs authority. It's not clear why this particular amendment was needed at all, because if there is no change in law and facts, then there shouldn't have been a need for going for an advance ruling with respect to that particular client. What it also clarifies is that advance ruling that are already in force, the 3-year period would be reckoned from presidential assent. The next provision amendment is with respect to it's sort of a clarification to say that when there is an investigation or an inquiry with respect to any customs matter, the jurisdiction will always lie with the officer who has originally done the assessment. So all reassessment adjudication would have to be done by the original officer and not by the investigation officer or the audit officer. The next provision provides for certain consequences where the information import-export data submitted to the customs is leaked. So it provides for a fine of 50,000 up to 50,000 or imprisonment, which may extend to 6 months. Recently, we have heard a lot of instances, whether it be customs or whether it be DGFT, whether data is leaked left, right, and center. Hopefully, this would actually be implemented in spirit, and there would be penal consequences for leakage of data. And the last amendment, which also my colleague would have spoken, is the SEZ laws which are proposed to be replaced. We are all aware of the mover scheme and the challenge to WTO, and we were all expecting that something would happen to SEZ with respect to the benefits granted. It needs to be seen, what are those amendments and how does it align to the overall mover scheme, etc., which has now come under the customs law. This is all from the indirect tax side. Thank you very much.
Yeah, and thanks so much, Ritesh bhai.
A lot of questions.
Lot of questions. Absolutely.
Virtual digital currency. Most of them virtual digital assets.
Oh. Okay, let's take the first one. Since you mentioned virtual digital currency, Ajay, that's Ajay's favorite topic. That's got him excited. When the dematted assets are taxed at lower rates, treated like any other normal income, similar digital asset gains are taxed at 30% plus. There'll be overlapping of assets between dematted assets versus digital assets versus digitized assets and digital assets. Are there clear distinctions laid out? Are the losses allowed to be carried forward? If there is no consideration or adequate consideration, how will TDS be done? In case of transactions between NR and RI, resident individual, for various digital assets, which section will have to be used? There are several questions within one question.
So I think, Arun, firstly, what we need to realize is the way they have brought in this whole tax regime on virtual digital assets, VDA, is completely different from what we are used to as capital gains. Yeah. Because one fundamental difference is capital gains is from transfer of a capital asset, and there's a definition for transfer and there's a definition for capital asset. Yeah. So one of the things the FM could have done is to include this as a capital asset. Then we would have gone into when would it be transfer? Would it be an asset situated in India, section 9, where it accrues, all of that. What she's simply done now, which I think is a good thing to, reduce litigation, etc., is to say that there is a different asset defined as virtual digital asset. And whatever is the income arising out of it is taxable under this section. So it's not from transfer, it's any income arising out of that. Income from the virtual digital asset. Therefore, to compare it to shares and digitized, and is it a different thing? I think the whole tax regime is different. It's not just the tax rate. It's also the charge is different because it is not on transfer. It is income from this asset that is taxable. And therefore, it is not comparable in that sense. And secondly, we are hearing this, Arun, all over. It's not something that India is dealing with. Even other countries today are, grappling with the issue on how do they bring these to tax? Because can somebody argue that these are not assets, it's extraterritorial? Because where are these located? If it's a cryptocurrency, if it's a share in a demat account, you know where the demat account is, you know where the shares issued by the company, where that company's registered office is. I think this is a completely different type of an asset, which has a different tax treatment, and we may not get anywhere if we compare the two and look for alignment.
Sure. Dinesh, you want to add to it, or can we go to the next one?
No, I think as Ajay put it, I think this is not unusual even within the Income Tax Act. So, for example, under the Income Tax Act, we have separate provisions to tax speculation income. We have separate provisions to tax income from horse racing, etc. So, it's been created as a separate class, and Ajay is absolutely well on that. If one has to it's not about equity, it's about really the approach which the government is taking to income from such assets.
Yeah, a connected question by someone else, whether surcharge and cess will be applicable on the virtual digital assets.
It will be applicable. And Arun, I did see another question on minimum exemption. Actually, 115, I'm just reading it once more, 115 BBH. while one it does not have the minimum exemption, which means whatever is the income from these assets will get taxed and balance will get into other taxation. Therefore, it's sort of effectively taxable from the rupee 1.
Yeah. Can I file an updated return if my income and tax is the same, but I just want to correct some clerical error? Maybe, what if the shareholding mentioned in the annexures is wrong in a private company? So maybe something like that. But yeah, Ajay?
So Arun, both revised return and the updated return provisions run parallel. The revised return provisions stay as is. So if there is a clerical error, omission, etc., the revised return provisions are there. But if that time limit has expired and you're wanting to update the updated return, when you can do it, it's a very clear thing in law and it has to result in additional income. And I don't think you'll be able to do it if the income is not changing.
Perfect. One second, I'm just trying to scroll through. Section 14A explanation suggests retro change with respect to applicability in case of no exempt income during the year. Is that the correct way of reading it, or is this prospective only?
14A is prospective. It's not retrospective. The surcharge disallowance is retrospective. 14A clause per se does not have any date of when it will come into effect, and any clause which does not mention the first, the Finance Act 22, therefore it's 1st April 23 assessment year onwards. So it is a prospective one, not a retrospective, even though it's clarificatory in nature.
There are a couple of questions with regard to the depreciation and goodwill part, Ajay, and
on depreciation goodwill, I think it is more of a aligning, and that's why it's gone back to when the depreciation, which is last year, when they stopped holding goodwill as depreciable asset. This is really a consequential thing, which is if you are reducing your block because it is not goodwill and it is you're reducing that block, then to that extent it will be deemed to be a transfer. It has nothing new that is coming in. It is just a consequential, and that's why it's going back to last year.
Okay.
Yeah, both the provisions, whether it is a goodwill or slump sale, where there is a definitional thing to say that it's not applicable only to a sale but to any transfer. Both of those are consequential and are not substantive amendments.
Arun, one other thing which I did not touch upon, and there are a lot of questions, is this new 194R, which is from that benefit that is there. Now, this is again only a TDS provision. There's no new charge coming in. There was always 28(4), which taxed value of a benefit or a perquisite, not for employees, but others who get as business income. What the FM did mention in the speech was that a lot of the people were not offering these to tax. And she took the case of, I think, business partners who were getting benefits in kind, etc., agents or whatever. And I think this has been brought in only to bring those into tax net. And that's why 194R has been introduced. And if you see, 194R is also put under the category of widening and deepening of tax base. So it is not a revenue garnering measure. It's not a revenue mobilization measure. It's really a TDS provision has been brought in to get more data of those transactions, and that's always been taxable.
Yeah,
but in a sense, Ajay, this is a smart move, because detecting income which is covered by 28(4) was always a challenge.
Right.
The question was what mechanism the tax office have to find out such an income. Now, because the onus has been put on the payer will be very, very particular to ensure that there is a withholding, but otherwise there could be different consequences.
Yeah. There's this one I found interesting. Manish Sharia, he says, whether introduction of explanation 3 to section 37(1) will be retrospective or effective from AY 2023. Ajay, if I remember correctly, is this relating to that payment legality, illegality, and India or abroad? I think it says it was always supposed to be like this. But Ajay, please do have a look whether I missed that. But if I recollect correctly, my first impression was this.
Prospective.
It's prospective?
It is prospective, though the explanation uses the phrase shall be deemed to have always included expenditure, but the clause comes in only prospectively.
So Arun, it's actually a bit of a enigma. So when a provision is put, which is so to say clarificatory, which says this is what we always meant, but it is from up. So what happens is the courts, when they are dealing with the earlier years, might have to take that into account as to what would they want to do. But clearly we have judgments which have held that when a payment is illegal or against public policy, it is a public policy in India, it is the law in India which needs to be contravened, not an overseas law.
Okay, clear. Great. There are a couple of indirect tax question. I'm losing track, but let me just try. 1 second. Give me a minute. So many questions here. Yeah. Whether transfer of credit balance lying under electronic credit ledger can be transferred, Ritesh?
No, the specific provision is only with respect to cash balance. Unfortunately, not with respect to credit balance.
Yeah, and the next one is ITC can be re-availed on vendor paying the GST due. Whether this amendment is with effect from 1st July 2020.
So ITC could have always been availed after the vendor has paid the tax. So this is not something which is new. What it merely says is that now the recipient who has taken the credit will have to reverse and pay interest. I think that is a problem over here.
Okay.
There's another question which is sort of been something that's been widely debated already, even though so quickly, is that is this the step for legalizing cryptocurrency? And I think I'll ask Dinesh also to add one important thing all of us have to remember is as we speak today, at this point, it is not illegal. There may not be a enabling provision which clearly states that you can do things or whatever. But today, right now, there are, procedural things. Banks are taking the position that they are. But at this point, crypto is not illegal. The government has not come out with any regulation specific to that. But this taxation thing does not change the current position on cryptocurrency. Dinesh, anything there you want to add?
I would agree. I think the fact that cryptos exist and the fact that there is NFT, etc., is all too there on the parliament is debated. There was a bill to be introduced which has not been. So all that this bill does, finance bill does, is to recognize the existence of digital assets and say that income arising from that will be taxable in a particular manner. It does not make it more legal or less legal than it otherwise was.
A question from me, Dinesh and Ajay. There have been amendments on the faceless, side. So, any larger message that the government is trying to send with those amendments?
No, I think the way things are is that, like any new proposition takes time to settle down, faceless is settling down. We have the issue as to whether when somebody asks for a hearing should be granted or not, whether that hearing should be virtual, physical. Number of those things are getting settled as we go along. I don't think there is any specific message except that the government is determined to make this happen. For example, even in the finance minister's speech, she spoke about something very different, which is to say all your bills to government department will be submitted electronically, will be processed electronically, so you don't have to interface. So that's the way the government wants to go, and rightly so.
Yeah, Dinesh, pre-budget, I was on a panel on a business channel, and I did mention that in terms of expectations, with the flight of the uber wealthy people, from the country, a lot of people are looking at setting up their bases overseas, shifting their bases overseas, and so on. That the budget needed to contain something to lure them back, or at least send out a message to the ones remaining here that we care for the rich as well, or we are not here to target y'all. You think the long-term capital gain surcharge capping is any message for the super rich at all, Dinesh bhai? Would the government be concerned with the numbers that have come in over the last month or so, which says that over 1 lakh Indians, I think, have renounced citizenship in the last 2 to 3 years, Dinesh bhai?
So I think there are two separate questions within this, Arun. Have people left the country? Yes. Was tax or what regulatory regime one of the reasons? The answer is yes. Have there steps which have been taken generally over a period of time to assuage the feelings? The answer is yes. Does a lot more required to be done? Again, the answer is yes. I think globally, again, we are moving towards a situation, and you are aware, Arun, we spoke yesterday that a country like UAE, which was a total tax paradise, has introduced a corporate tax. Of course, not for individuals as yet, but there is a 9% corporate tax for whatever it is. But what happens is once you have tax, then there is information with the government, transparency comes in, and everything tends to get legitimized. So I think, can the government do a little bit more to assuage the feelings of people? Yes, a lot more needs to be done. I did mention at the beginning of this webinar, Arun, that one of the rare times that the finance minister acknowledged twice over the contribution of the taxpayers to this country. There's a lot more which needs to be done, whether it is automatic refunds, whether it is even-handed assessments, etc. A lot is required to be done.
Yeah, Dinesh, I can't, not ask this question because it's there on my Twitter feed. So many people have posted, and a lot of the followers on Twitter are not have nothing to do with tax. Though some of my friends like Ajay do. And the buzz is that what has the middle class got on the tax side? What has the middle class got from the tax side is the question.
Yeah, there are two ways again to answer this, Arun. First is there was a demand for standard deduction, which has increased in standard deduction, which has not happened. People have made money on the stock exchange, including middle class, and maybe some of those gains will be taxable at a lower rate. But I think if the government does not need to do everything on the tax side. The fact that there is investment, the economy is growing, more funds are coming, itself gives impetus to the economy. So if the government is able to create more jobs as a result of more investment happening, capital being deployed, new industries coming in, that itself is a good thing to happen. So not everything is tax, really.
Yeah. One question to Ritesh here, and we are about to close in the next few minutes. Ritesh bhai, on the GST side, custom side, you said that we barely expect anything nowadays, and yet a lot comes.
Yes, absolutely.
But when you look at these, and I heard you quite with intent, and I tried to absorb, but it'll take me time to absorb what you mentioned on the input tax credit side. Practical, tomorrow morning, what are you going to be advising your top clients?
See, the first question which is going to come from all the clients is, how is it practically possible to implement the provisions which the government has just announced? What you are talking about is a supplier defaulting in terms of payment of tax, in terms of taking a wrong credit, etc. How is the recipient supposed to know, in what instances has he defaulted, where he has gone wrong?
What will be your advice?
Our advice would be to challenge those provisions.
Yeah.
Because the machinery provisions, around this in terms of communication to the recipient do not exist.
Sure.
I cannot be forced to suffer a consequence because of a supplier's default.
Yeah.
And specifically when that default is not communicated to me by any, amendment or any maybe technology change by the government.
Yeah. Dinesh,
I can just make one comment there. Even in direct taxes, there has been this issue that if taxes have been withheld by the payer, whether the person has deposited or not, I ought to get a credit because I have suffered the withholding. The government has a right to recover. The same thing would happen here.
Perfect. Dinesh, just a question. 4.5 years after the introduction of the GST law, on the one hand, you have robust tax collections and so much going well in terms of the e-way bill mechanism, maybe in terms of, maybe the center takes state relations not being as bad as we thought it could be. But you also have a lot of litigations, incredible number of litigations, a lot of advanced rulings. And right now, we again seem to be on the cusp of a fresh round of litigation, Dinesh bhai. When we thought that a new indirect tax regime will actually put the litigation legacy behind, Dinesh bhai.
I think the true benefit of GST has been the fact that we have done away with multiplicity of laws. We had seamless transportation of goods within the country, no check nakas, no nothing, all of which is very much welcome. I think we Indians, as we often say, are argumentative Indians. So litigation will continue to happen and will keep going. But I think it is a fact that a lot of informal economy has come into the formal sector.
Sure.
It is also a fact that some of the MSMEs have suffered, etc. But overall, it's in the right direction, I would say, overall.
Yeah, I think 5 years is always a good time to assess it. Ajay, on the virtual digital assets front, Ajay, are the provisions clear enough, or do you think we will need a 20-page circular to clarify a lot of these the scheme?
we may not need 20-page, Arun, but there are some things, especially on set-off of losses, because it's not as clear. You understand the principles that this loss is not available to be set off against other things. But if you just, you want to hair split and read word to word, it uses a singular, it says virtual digital asset. Does that mean within the class, you can't set off a loss from Bitcoin against NFTs? Those are things which are open. But I think we'll have to just see, because the other thing, Arun, you will agree, this government last few years at least, they have addressed some of these while passing the bill. Of course, they've also done things like equalization 2, etc. before passing. But we'll have to just wait and see what will come the final.
Dinesh, this is Ajay. This is more on a a lighter vein. Thank God we don't. The Bitcoin still don't issue bonus Bitcoins and so on and so forth.
But just on that point, and let's close with it.
Yeah.
There was this hope that many of us had, that there will be many clarifications that we badly need on equalization levy.
Yes.
On certain aspects of M&A.
Yeah.
I also see that tendency to say we have put the law, now we are not going to clarify anything further.
Okay, perfect. Perfect. Ajay, 10 seconds.
No, I think overall, for me, the key takeaway around, no significant changes which are not called for, fewer changes which are good. Like I said, reasons are there for each of those changes, which is, I think, a very good development.
Ritesh bhai, next 6 months you're going to be busy, yes or no?
Absolutely.
That's great news for you, Dinesh bhai. The last word always belongs to him. Last 5 seconds, Dinesh bhai.
I think away from all the finance bill provisions, great budget, something which will put economy on the right track. One only hopes that implementation happens in a very robust manner.
Would you agree, Dinesh bhai, just yes or no, that reforms is still the buzzword, that we
Absolutely.
are on the path of reforms?
Absolutely.
On that note, we close this webinar. Thanks for this wonderful participation. Once again, we have a full house, and thanks for the for those who've been watching it on YouTube, several hundred of them. Thanks to all the Dhruva Advisors partners, Dinesh bhai, Ajay, Ritesh bhai, and of course Mr. Sanjeev Mehta of HUL, who took out time and print from ITR. This was a special post-budget webinar from Dhruva Advisors, Taxsutra, and International Tax Review. We bring this every year to you, and we cannot wait for the next budget. Exactly 12 months from now, 5 p.m., we will be back. Do log on to taxsutra.com for the real-time analysis of all the budget provisions, the fine-print analysis.
Thanks
you once again from everyone here.
Thank you.
Thank you.